to Corporate Law Journal channel. In this video, we'll be discussing National Financial Reporting Authority Order 008/2024 under Section 132 Clause 4 of Companies Act 2013. The parties involved in this issue are Pathak HD Associates, the audit firm, Chartered Accountant Parimal Kumar Jha, who was the engagement partner, and Chartered Accountant Vishal D. Shah, who was the engagement quality control review partner. The facts of the case are Reliance Capital Limited was jointly audited by Price Warehouse and Company LLP, hereinafter PW, and Pathak HD and Associates, hereinafter PhD, for the financial year 2018 to 2019. Price Warehouse resigned from the audit and filed a report to the Ministry of Corporate Affairs under Section 143, Clause 12 of Companies Act 2013. Price Warehouse had reported suspected fraud, but the audit report published by Pathak Associates stated that there is no matter that attracts Section 143, Clause 12. National Financial Reporting Authority took suo motu cognizance and observed prima facie non-compliance with Companies Act and standards of auditing by Pathak HD and Associates. Show cause notice was issued to the auditors, the firm, and both the chartered accountants. Reliance Capital Limited had loans from banks for around 12,000 crore and other external borrowings of rupees 32,000 crore. These loans and borrowings were used to extend loans and investments to other group companies. Price Warehouse suspected fraud amounting to rupees 12,571 crore with respect to the amounts mentioned above. In order to understand the order issued by National Financial Reporting Authority, it is important to understand the sections concerned. Under Section 132, Clause 4 of Companies Act 2013, National Financial Reporting Authority shall have the power to investigate, either suo motu or on a reference made to it by central government, for such class of bodies or persons into the matters of professional or other misconduct committed by any member or firm of chartered accountants registered under Chartered Accountants Act of 1949. Under Section 143 of Companies Act 2013, the powers and duties of auditors and auditing standards have been laid down. Under Section 143, Clause 12, if an auditor of a company, in the course of the performance of his duties as an auditor, has reason to believe that an offence involving fraud is being or has been committed against the company by officers or employees of the company, he shall immediately report the matter to the central government within such time and in such manner as may be prescribed. Multiple charges were brought against the auditors, who were then required to file their replies for the same. First charge includes failure to disclose a material fact which is not disclosed in a financial statement, but disclosure of which is necessary where the statutory auditors are concerned with that financial statement in a professional capacity. Second charge is failure to report a material misstatement to appear in a financial statement with which engagement partner is concerned in a professional capacity. Third charge, failure to exercise due diligence and being grossly negligent in the conduct of professional duties. Fourth charge, failure to obtain sufficient information which is necessary for the expression of an opinion or its exceptions are sufficiently material to negate the expression of an opinion. And fifth charge, failure to invite attention to any material departure from the generally accepted procedures to audit applicable to the circumstances. Findings of the National Financial Reporting Authority include, firstly, violations of the responsibilities of joint auditor. It was found that work was not distributed between the two auditors, but both were jointly and severally responsible for the entire audit work. Price Warehouse mentioned that rupees 12,571 crore is an irrecoverable loan that was portrayed as recoverable in the financial statements of Reliance Capital Limited. However, engagement partner was in non-compliance and did not carry out statutorily mandated independent procedures. Group companies who were given loans by the company had serious credit impairments according to the resigned auditor. The business rationale behind giving these loans was not explained. Pathak HD and Associates was required to conduct independent audit procedures for the same but failed to provide any evidence of the same. Communication between Price Warehouse and Reliance Company was copied to Pathak HD and Associates, and National Financial Reporting Authority held that this was sufficient basis for independent procedures to be undertaken by the engagement partner. National Financial Reporting Authority also holds that the behavior of the auditors is a serious deviation from the fundamental tenets of professional skepticism and behavior required of an auditor. Second finding is based on self-review of financial statements. Audit Committee asked Pathak SD and Associates to fully examine all the transactions referred to by Price Warehouse. Hence, Audit Committee noted that Pathak HD and Associates concludes that the transaction referred to do not trigger the provisions of Section 143, Clause 12. Before this view of Pathak HD and Associates, there is no evidence of audit committee taking an independent view. Statutorily, they had 45 days to examine the same claims. This conclusion is reported in the financial statements which were in turn reviewed by Pathak HD and Associates. This amounts to self-review. Statutory auditors in this case were found to be providing inputs for the company's records. Audit committee's conclusion was based solely on the engagement partner's presentation to the committee on noted observations not attracting provisions of Section 143, Clause 12. The order also emphasized that reporting a suspected fraud is a duty that is cast upon the auditor and the auditor must fulfill his duty. Third finding was based on the use of emphasis of matter. Engagement partner used an emphasis of matter to state that the report filed by Price Warehouse does not attract Section 143, Clause 12, and that Price Warehouse's reporting was unwarranted. Emphasis of matter is added to indicate a matter, which is disclosed appropriately in the notes, forming part of the financial statement that the auditor considers is fundamental to the user's understanding of the financial statements. The auditors in this case took refuge under the legal opinion for determining that Section 143, Clause 12 is not attracted. However, determination of the auditors was made almost 2 months before the legal opinion was shared. Furthermore, conclusion of legal experts was based on correspondence between Price Warehouse and Reliance Company and not on the merits of the issues raised by Price Warehouse. Representation in the emphasis of matter that engagement partner relied on legal opinion for his perusal is misleading for the users of financial statements and shows unprofessional behavior on the part of the auditors. Emphasis of matter was not the appropriate form of reporting. Emphasis of matter should refer to information disclosed or presented in financial statements and should indicate that the auditor's opinion is not modified in the matter. Fourth finding was based on impact on financial statements of matters arising out of observations of the registered auditors. Statutory duties of the auditor require them to form an opinion on the financial statement as a whole, including the effect of the matters brought to the notice by the erstwhile joint auditor, Price Warehouse. Engagement partner formed a conclusion on these matters without performing adequate audit procedures and obtaining sufficient appropriate audit evidence. Engagement partner noted matters which suggest credit impairment of borrowing entities. However, he failed to do any testing to rule out that impairment. Business activities of none of the borrowing entities were documented to confirm whether loans sanctioned were utilized for genuine business purposes or not. There was no examination of bank statements to rule out evergreening of loans. There is significant default in repayment ranging from 60 to 150 days. There is no adequate consideration of fraud risk factors. Fifth finding of National Financial Reporting Authority was based on verification of lending policy. Engagement partner documented the lending policy. Testing of compliance was limited to loan approval by authorized officers. Glaring deviations from the lending policy were well documented and were evidence of dysfunction of internal control over loan sanctions. Engagement partner's contention that lending policy is beyond his role and duty is unfounded and shows a lack of understanding of his own duties on the part of engagement partner. According to Section 143 Subclause 1, Subclause A, auditor must inquire into whether loans disbursed are prejudicial to the interest of the company. Company investing in credit impaired entities in violation of its own lending policy is prejudicial to the interest of the stakeholders. Sixth finding by the authority is based on assessment of risk of material mismanagement due to fraud. There is no identification of fraud risk in revenue and management override of controls. There is no proper testing of journal entries, reviewing accounting estimates for biases, etc. Engagement partner has been found to disregard many of the important and mandatory provisions. There is no specific examination of risk factors. Compulsory convertible debentures were sold at a value more than its fair value, and transfer of funds between multiple entities was done in multiple tranches on the same day. All of these combined to make suspicious activity for which there was no independent procedure. Hence, there was a failure to identify and respond appropriately to risk of material misstatement due to fraud in management control. Seventh and last finding of the National Financial Reporting Authority was based on the omissions of Engagement Quality Control Review Partner. The Engagement Quality Control Review Partner agreeing with the engagement partner shows professional misconduct and absence of due diligence and gross negligence. Engagement Quality Control Review Partner is required to apply objective wisdom to ensure that the engagement partner has complied with all the requirements. Engagement Quality Control Review Partner failed to objectively evaluate and question the engagement partner when he failed to meet the relevant requirements of standards of auditing. Pathak HD Associates is a legal entity appointed under Section 139 of Companies Act 2013 as the auditor for Reliance Capital Limited. Report issued by the legal entity, signed by the engagement partner, is the primary responsibility of the legal entity issuing the report under the Act. Hence, the auditing firm is answerable for its report issued under the Act. The role of the audit firm is as important as that of engagement partner and engagement quality control review partner. The audit firm should have discharged its supervisory responsibility timely and effectively. This could have resulted in major auditing lapses being avoided. National Financial Reporting Authority passed its judgment. It is proved that all three parties to this issue did not exercise due diligence and were grossly negligent in the conduct of their professional duties by not adhering to the mandatory requirements as laid down by relevant statutes. All three parties committed professional misconduct as defined under Section 132, Clause 4 of Companies Act 2013. Given the high degree of public interest in Reliance Capital Limited, it was the duty of the auditors to conduct their audit with the highest level of professional skepticism and due diligence and report their opinions in unbiased manners. Monetary penalty of rupees 3 crore was imposed on the audit firm. Monetary penalty of rupees 1 crore was imposed on the engagement partner, and monetary penalty of rupees 50 lakhs was imposed on the engagement quality control review partner. Both the auditors were debarred for 10 years and 5 years respectively from being appointed as an auditor or internal auditor or from undertaking any audit in respect of financial statements or internal audit of the functions and activities of any company or body corporate.